Hello, this is Bennett, Forrest of the Meali team, Keller Williams Legacy Partners. Here today with our preferred lender, great friend of mine, Jason Kilduff, Ward Kilduff Mortgage. How you doing today, Jace?
Good. How are you?
I'm great. Yeah, thanks for coming into the home office here. We've been talking about doing this for a long time, and you know, the number one question I get when I'm talking to people about buying and selling houses, what's the first thing they ask?
They ask what the rate is.
What's today's rate?
I get asked that same question numerous times.
Exactly. So my question or my answer is, well, that depends, right? What is your answer when someone says, so what's the rate doing today?
Well, it's a common question, and people will ask, oh, hey, I'm just calling, what's the 30-year rate today? Well,
okay.
If you do a little bit of digging or have a little bit of knowledge in the industry, you'll know that lenders and investors in the secondary market post a rate sheet every morning, and that rate sheet may go from 6% to 9%. And every rate in between those two numbers is openly available.
Okay, so what is a rate? Who's producing these rate sheets, and what is a rate sheet? Like, where do these numbers come from?
They're going to come from mortgage-backed securities, basically, and how they're pricing.
Okay.
And what Fannie Mae, Freddie Mac, entities of that nature are paying on the secondary market.
Okay, so when you say paying on the secondary market, so someone lends money and then they buy those loans from them, or?
Right. So, I mean, to backtrack a little bit, right, there's margin built into those. So when I do pre-qualifications or pre-approvals for people, we're going to look at credit, property type, amount of down payment, and all those things are going to factor in. Okay.
Okay.
So, for example, Fannie Mae and Freddie Mac are going to have service level price adjustments. Okay. So, for somebody, let's take an example with a 680 credit score that came in to the office or called me and said, you know what, I know I have a 680 credit score, but I want to get the same rate as the guy with the 800 credit score. We have two options there. We can wait, right? And the client can improve their credit till they get to an 800, or Fannie Mae is going to have adjustments to the pricing built in, and they're going to say, okay, it's going to cost that person 1.5 points or 1.5% of the loan amount, because that's going to be the Fannie Mae adjustment for a 680 credit score. And I'm just using that as an example.
Okay, so basically, so let's back up one more step though. So when you said the rate sheet 6 to 9%, is there one like official rate sheet that?
No, every investor or bank or lender is going to produce their own rate sheet.
Okay, so what? So Bank of America,
correct?
Rate sheet. Okay, your company. Do you? Where do you? So you're an independent broker,
correct,
and you work with you put people together with the bank that best suits their loan profile, right? So does every single one of the banks you work give their own rate sheet?
Yes.
Okay. All right, and so that's based on the markets, and we don't need to get into the stock market and the bond market and all those things that you get paid the big bucks to look at, right? So for the layperson like me or my clients that just want to know basically how it works, is that some economic factor dictates the daily rate sheet that each bank puts together.
Correct.
Okay, and then there's a range there.
Correct.
All right, and where someone fits in on the rate, what'd you say, the standard rate without paying any money? What was that term you used?
Right, like a par rate, right, is going to be a rate that doesn't cost you additional discount points to obtain, and that you're not getting a margin back, right? Higher rates may pay the borrower some sort of closing cost credit.
Right.
Okay, so that's where there's a big swing, because every single rate, whether it be 7.125, 7.25, 7.375, there's always going to be an underlying price associated with that rate.
Okay. That costs the borrower.
That costs the borrower either something they see visibly as a charge or an adjustment to the rate.
Okay. All right. So you have these rate sheets that are adjusted slightly every day by every bank, right? And would you say that most banks are in the same basic ballpark of the range, that range? Or is Bank of America different from Webster Bank? Like, is their rate sheet like more or less the same, or is it like completely different?
They're going to have completely different rate sheets.
Okay.
Probably not too far off, right? But enough to make a difference and enough to show the borrower the importance of shopping the rate.
Okay, so the range of interest rates will vary between different banks.
Correct.
Okay, so then so when someone comes to you, so there's a base rate, and then you said someone with excellent credit will get a lower rate, and someone with worse credit will get a higher rate.
I always explain to
how would you explain
the Fannie
how that
Mae
works?
adjustments that are built in on the back end of things. If you equated it similar to auto insurance, right? In a simplistic format, let's talk about that, right? You come into an insurance agent for automobile insurance and you have 5 speeding tickets. Right. You're expected, or you should know, that you're going to pay more than someone with a perfectly clean driving record, right? Okay. Same thing with interest rates. You can assume that the pricing for someone with 800 credit score that's putting down 50% is going to be better than somebody with a 675 credit score that's trying to go on a conventional loan with 3% down. Okay,
so that's a great analogy. So everyone knows you have car insurance and you get into a wreck or a speeding ticket, and then the next time the billing cycle comes up, you go up. So rates work similar to that, except it's affected by credit. And what else? What else affects it? Income?
No, not income, because either you qualify or you don't qualify.
Okay.
Right? But what's going to affect it is going to be credit, right? Amount of down payment and property type. Okay. So like, for instance, a condominium has different adjustments that are different from a single family and occupancy, right?
Okay.
So obviously, if it's your primary residence and you're going to live there, that's to the benefit, right? Because the way the banks look at that is say, okay, well, if the guy has, or the client has, bills that they are going to have to pick and select what not to pay, chances are the bill that's associated with a roof over their head is going to be the top priority for the borrower.
Good. Okay. Yeah, that's a great point to point out, that the banks view the risk of a borrower differently, whether you're going to be living there as your home, primary occupancy, or if it's an investment property.
Correct.
Because a lot of people, invest in real estate, whether it's multifamily or whether it's a flip or whatever. So that's one thing that they're doing. So when they borrow money, they're considered a higher risk by the bank because they're speculating basically, and it's not where they sleep every night. So they're less incentivized to pay the mortgage every month, or what?
Right. Yeah. Well, if someone had their primary residence and a couple of investment properties and they fell on hard times, the one that they choose not to pay is probably not going to be their primary, right? Gotcha. It's probably going to be one of the investments, or the investment that's not performing as the other one.
Gotcha. Okay, so someone has financial trouble, and you've got electric bill, you've got gas bill, you've got your mortgage payment, and you've got your car payment, and then you've got an investment property, and you got six things, and you only have enough to pay 5 of them. The general idea is that most people are they're going to keep the lights on, and they're going to keep their mortgage payment.
Correct.
Is that just sort of a general rule?
Yes.
Okay. So I think investing in real estate is a separate conversation, because most of the people I talk to are about either they want to buy their first home to live in, or they want to sell their existing home and buy a new home from some kind of life event, whether it's a growing family, a shrinking family, a death in the family, a divorce, a marriage, whatever. Life changes happen. And so the majority of the real estate and residential real estate that we deal with is probably majority people that are investing in their primary residence. Would you say?
Yes. I would say that's a majority of people financing.
Okay, so let's keep this conversation to that. So someone says, I want to buy a house. The first thing is, the bank is going to say, do you have enough money to pay back a mortgage payment every month, right?
Right.
So they're going to look at your income. Then they're also going to say, do you have a history of paying your bills? If you, just like with a car, do you have a history of not getting speeding tickets? Then we're going to give you a lower price. And if you have a history of good credit, it shows that you as a consumer, or as an adult, as a tax-paying adult, that you have generally are responsible with your things, with your finances, because you pay.
Right.
And so that's why credit's important, because it shows your track record of being of saying that or paying what you say you'll pay, whether it's Verizon or whatever.
Right. The ability to repay.
Okay.
And the history.
Okay. So you got that rate sheet, right? And then if someone just says, what's my rate? It's a combination of not income. You said down payment amount or type or purpose.
Yeah, amount of financing or loan to value, right? So the percentage of the purchase price that you're putting as a down payment,
Okay.
right?
So if you put 5% of the purchase price as your down payment, you're going to get a higher rate than if you're putting 20% down.
Right. In theory, sometimes they run close on that because you have to think about that the bank has extra insurance, right? PMI, right? To cover.
Yeah. Yeah. And we don't want to get too in the weeds.
We want to give
people,
but just think that the bank has less risk if someone was putting down 30% than if they're putting down 3%.
Okay. And it's the same kind of concept. If you have 30%, it generally means that you have cash on hand. So I always use the example, if your car breaks down suddenly, no one's happy about that. But if you have stability and cash in the bank, then you could absorb an unexpected financial event that happens.
Correct. But on the flip side of that, right? If the bank had to take the house back and you had 30% equity in it, the likelihood that they're going to have a loss on that property is slim, right? Unless the market turns and housing prices come down.
Okay.
But if the bank has to take the house back from you and you have 30%, 40%, 50% of equity, the likelihood is that they could foreclose and sell that home and get all their money back.
Gotcha. Okay. So that's the other benefit to the bank is that you have more equity. From the day you buy the house, you have more equity. So if either the market goes down or you fall under financial hardship, you have room to take a little bit of a loss, right? Everybody buys a house, they think it's going to go up in value. But if they can't pay their mortgage or it does go down in value, then at least they have money in the house that they can get out of the house and the bank will get their money back. Because ultimately that's what the bank's trying to do.
Right. The banks aren't in the business of owning real estate.
They are or they're not. They are not. They're in the business of lending money and getting interest.
They would prefer everyone paid on time.
Okay, good. All right. So that's great. So the better your credit is, the better your rate's going to be. Okay. So another thing we get all the time is people on TV, whether it's I won't name the online companies, but we all know who they are, or they're driving by. There's a mortgage company down the street here, and every day they post the rate. Right. So someone calls you and says, big bank A says they can do, I saw the sign that says 4%, but then now you quoted me at 5%. What would you say to that person? When someone says bank over here can give me 4%, why are you giving me 5%?
The truth is it's always in the disclosure, right?
Okay.
So everybody's used to looking at that and they'll disclose the terms and conditions under which someone could obtain that, right?
Okay.
They're also going to disclose an APR, right? Annual percentage rate. Okay. Now, say you came to me and what they refer to as the par rate without any points, right? Say that rate today was 7.5, but you said, you know what? I don't want a rate that's higher than 7. Okay, well, 7% is also available, as we discussed.
Now, let's pretend this guy's got amazing credit. This is the best credit, right? Yeah. So the best credit person, 7.5. Okay, continue.
Okay, and let's say the client needed to get 7% either out of personal preference or to qualify. Okay. Right? That 7% may have a cost on it, right? Associated with maybe one discount point. Okay. And one discount point would be 1% of the loan amount. Okay. So they can get the rate down there to 7%. It's just going to cost them out of pocket by means of a discount point.
Okay. So you ask someone if it's their primary residence, you check their credit and you ask them how much of down payment, and assuming people are giving you the real information, then the rate you give, it's not set in stone. They can pay money to have a lower rate.
Correct.
Okay.
Prepaid interest, right? So they're going to pay the bank something up front for a reduced rate over the life of the loan.
Okay. So why would someone pay down the rate? What would be an example?
They may be more comfortable with the payment, right? It may make financial sense. So one of the things that we do when we kind of figure out the benefit, the pros and cons of paying points is what is the recapture time, right? So I'll give you a real simplistic answer, okay? Say it's a $200,000 mortgage, and when we buy the rate down, the client's going to opted to pay 1 point. So $2,000 they're going to pay for a reduced interest rate, okay? Say the payment
they're going to write a check, so they're going to put it down. This is over and above the down payment on the home. There's all these closing costs, and again, another conversation we'll talk about, attorney fees and all that stuff. But literally an additional $2,000 out of their pocket in order to get a lower rate.
Right.
Okay.
Exactly. So say that by paying that $2,000, the rate's lower and the payment's lower by $50 a month.
Okay.
Okay. That means, right, $2,000 divided by 50, that they have a 40-month recapture time on that investment.
Okay.
So their break-even point is 40 months. After 40 months, every month they keep that mortgage, they're putting $50 in their pocket, right? So that's kind of what we have to determine. And that leads into the conversation to the client. Let's talk about your financial goals and objectives. How long do you plan on being in the house?
Yeah.
Where do you see yourself in 5 years, 7 years, 10 years? And we dig a little bit deeper to determine whether or not that's an adequate investment or something that they should do.
Yeah. And I think you hit on, that's a great point. And that's the whole point of this conversation is to sort of get a handle around rates, right? So people, and there's also a kind of a psychological thing. People feel good if they have a 3.99 rate versus a 4.0 rate. And people only look at, if you're short-sighted and just look at the rate and what that translates to per month, you may be gaining in one area, but you may be losing in another area.
Right. Because there's a lot of thought process. The longer the recapture time, the less sense it may make, right? Because there's a time value to money too.
Okay.
What does that $2,000 look like if you didn't spend it on points, but you put it in a sector mutual fund or an S&P index fund?
Yeah.
What does that look like during that recapture time of 40 months? What does that 2,000 look at the end of 40 months?
Yeah, exactly. So what, I got a lot of what we're trying to get at here is that, people, buying a house is an emotional decision, but it's also, and it's a financial decision. And so the kind of commercials you see on TV, everything's geared toward this binary rate as if the rate was the be all end all. And so when people ask me the rate, and that's why I say it depends. And usually the next thing is like, I'll give them some general information. I'll say it depends on your credit. But what you really need to do is talk to a lender personally. Because if you go to an online lender, they may just quote you a rate, but they may not put it in the context of the fees they're charging you. And that's sort of another conversation is like, when you buy something on Amazon, you pay the money, you pay the taxes. There's no hidden fees, right? But when a bank tells somebody, here's your loan, your rate, that may be adjusted higher or lower because of other fees. And if they don't tell you about those other fees, you think you're getting a good rate, and maybe you are, but maybe, like you said, maybe you're paying money for that you're not going to get back you're not going to make up with the rate.
Right. So like just a couple like hazard signs in the roadway, right? Like if the rate looks ridiculously low compared to what you're seeing, chances are the lender's pricing that point or advertising their rate with points built in. And that's the reason that every rate that's published should also post an APR, right?
Okay.
Because the APR
in the small print, right?
Right. Yeah. And the APR is going to show basically the fees outside of the interest on top of the interest, right?
Gotcha. Okay.
On the flip side of that, a lot of places you'll hear advertised no closing costs. Well,
Okay.
There's closing costs. Your attorney has to get paid, right? The bank's going to have charges. How are they absorbing that and providing zero closing costs? Well, they're taking the rate that doesn't cost you anything and doing the opposite of points. They're building that rate up higher so that there's margin extra on the loan to pay your costs.
Exactly. So that's what we always, talk about with our clients is, and again, they also, not only do they do rates as a binary, but they also do like a house price, $300,000 house. And so what the conversation we're always having with our clients is it's about your budget. At the end of the day, right? If you're paying $1,800 in rent, right? And you want to buy a house and you say, okay, I'm paying $1,800 in rent, but I just got a raise. I can afford $2,000 a month in rent. Do we start with, if someone says I can afford $2,000 a month and I want to buy a $300,000 house, do you start with, let's get you a $300,000 house, or do you start with how much of a value of a home can you get for $2,000 a month?
Here's my feeling on it is the affordability is huge, right? So I
Okay.
want to present options and have a detailed, specific conversation with that client. So how we usually start is we're going to determine what the maximum the bank's going to allow for you to spend.
Okay.
More likely than not, that's going to end up being more than you're comfortable with.
Okay.
So
So I'll cut you off there. So the bank says, based on your income and your credit and how much cash you have, we're willing to lend you this. We have this computer model that's based on generally, loan to value ratios and things that says, based on your profile, we will give you a loan of up to this amount.
right.
Okay.
It's all going to be based on different aspects of your credit file and the strength of it and your debt to income ratio. I like to start there because we know where we're not going, right? Because where the banks will approve someone for much more than probably the normal person's comfortable with.
Why is that? Why do you think that is?
Well, I don't think that. I think when they build out these scenarios and they run the models, they don't take into account living expenses, right?
Okay.
So the inside of the debt to income ratio, so the percentage of your income that's going out to your debt, right, is going to be the new mortgage payment and anything else that's reported on your credit.
Okay.
Okay. So keep in mind that that could be credit cards, installment loans, car loans, things like that, right? So let's say Fannie Mae or Freddie Mac will go up to 45% debt to income,
Okay.
meaning that if you make $10,000 a month, you could have $4,500 a month in debt.
Of everything. Car payment, boat payment, student loans, all
Right.
your debt that you're paying off.
Right.
Okay.
And some will, be able to push it to like a 46, 47
Okay.
on a conventional loan, right?
Okay.
What they don't understand or what it's not really adjusted for is cost of living and things that's not on your credit report, right? So as we all know, we've seen it, right? It's the groceries are more expensive, gas is more expensive, but the ratio is still the same.
Interesting.
Right? So right now, people may not be comfortable with the amount of payment that they could actually get approved for.
Interesting. Okay, so the bank does it just based on some factors, but it's not taking into consideration the individual's lifestyle. So the way I would put it in maybe a little more layman's term is are you a Netflix and chill person, or do you travel and go on cruises and go out to dinner all the time? And everyone's got their own lifestyle that they're comfortable with. And so the bank is not taking into account whether you're a Netflix and chill or go out and spend a lot of money on things. So that's like your baseline, right? So if the bank says 400,000, right away we know you want to buy a $500,000 house, you can't do it based on your credit profile, right? And other things can change, you can get gifts or whatever. So that's our baseline. Then we have to do what's the next layer deep of saying, okay, this is what the bank will give you. Now what's the next part of that conversation?
Where's the client comfortable? Where would they love to see their monthly payments? Like where they can continue to live the life they want to.
Okay. And that's what we talked about a minute ago. When people say I can afford $2,000 rent or mortgage payment, the idea is most of the time they know their budget and they know what they can afford based on all their other bills that they're paying. So that conversation about what their comfort level is important. And then you marry that with what the bank will approve them for.
Right, because there's a lot of times that someone will say, I'm comfortable with a $2,000 payment. When they start looking at homes, they're going to realize like a $300,000 house, you could go down the street and the taxes could be $8,000, and you could go see another $300,000 house and they could be $6,000. And the taxes are going to change on the home, so the payment's going to change, and the taxes are going to carry a big portion of what the payment is.
Okay. So
it's always important, if they're really interested in a house, to definitely reach out to the lender and say, you know what, I think we're going to write an offer on 123 Main Street. Could you give me an update on today's rates? Because the rates are going to change every day, if not numerous times a day. Okay. And can you give me an idea of what the payment looks like on this house with this much down? And maybe we can put down a little bit more if the payment's too high, or maybe we can put down a little bit less if the payment's less than where we want to be.
Exactly. So then it becomes a math problem. And that way you can take the emotion out of it, right? We know they're only looking at houses up to a certain amount because we know they won't fall in love with a house that the bank won't lend them on. Okay, that's your starting point. Then you're looking in town A, and a $300,000 house will have, like you said, $5,000 in taxes. Town B, the next town over, may have the same house is $4,000 in taxes. So the monthly payment isn't just what you're paying on your note, right? So for example, student loans, you're paying the principal and interest on the loan. Same with a car loan, right?
Right.
But in addition to the car loan's the best. So you have an auto loan, you're paying that money, but you also know that separately you're writing a check to the insurance company, right? And then separately you're writing a check to the town for taxes. But with mortgages, when we say monthly payment, we're talking about all of those put together. We're talking about principal and interest on the loan, taxes and insurance. Add that up, and that'll give you your monthly payment. So that's why taxes are important, where the two $300,000 houses at the same rate, the principal and interest part is identical.
Right.
But then if you add, and then you may even add the insurance may even be identical.
Close.
But then you add the yearly taxes divided by 12, and just do the simple math. I'll put you on the spot. $6,000 a year in taxes. How much is that a month?
It's $500.
Okay, so $500, and $4,000 in taxes is how much?
You're really putting me on the spot.
Yeah, $350.
Or just say $4,800 a year in taxes is $400.
There we go. Easy math. Okay, so if you do the math, and house A and house B, one comes in $100 more than your budget, then even though it's the same price house, you may choose to use buy the one that fits your budget.
You know what, Bennett? I want to go out and look at houses that are no more than $300 and the taxes are no more than $4,800.
Okay.
Right? And then we can kind of fine tune it. It always starts off, picture it in an airplane, right? You're flying at 30,000 square feet. What we want to eventually do is get that plane close to the ground, right? Where you can get a better view and a better idea and a real clear picture of what's going to suit your needs the best.
Exactly. Yeah. And that's why, this is why you're the first person I wanted to call when I wanted to do an interview explaining this, because, we've both, I've been in the business since 2009. I'm coming up on 14 years. You've been doing mortgages since what year?
That's another good question.
Before 2009.
Since 01?
Since 01. Okay. Yeah. So we both seen the crash of 08, and we both come out of it. And now 14, 15 years later, we're still around. And of course, we've had this conversation behind the scenes with clients, hundreds and hundreds of times over the year. And so, again, I thought it'd be good to sort of have this conversation aloud for people who are just curious, so they can get an idea of what we're going to eventually talk about, right?
Absolutely.
Okay. So, getting back to that idea that it's not binary is, like you said, at 30,000 feet, it's an X amount of price with X amount of taxes. But then then you send them back to me, right? And then we go out and we look at a bunch of houses. Now I'm having more lifestyle conversations. I'll use my town. I'm in West Hartford. The taxes are 30% higher than the next town over, Farmington. Both towns have excellent reputations for schools. They're very stable towns economically. There's a lot more to do in West Hartford. There's a lot more public works and police and all that stuff. So that's why the taxes are higher. And Farmington is much lower, but it's more spread out. There's not as much to do. So when I'm consulting with a client, we look at both, and then now we can decide, well, and there's again no wrong answer. I prefer more stuff to do, so I'm willing to pay more taxes. So now, like you said, now we're landing the plane a little bit. We're going a little lower altitude. And so now they say, but that same house in West Hartford, now I can't afford it. And so but I really want West Hartford. So what's the conversation then? Because our job is to get them what they want. They want to be in West Hartford, right? So what do we do in that situation?
Well, you could buy down the rate, right, to pay points to get the mortgage payment down.
Okay,
right?
That's one thing.
So you could do that. You could reduce the price range that you're looking in. So you go from $300 to $250, right? Reduce the mortgage payment that way, right? And those really are the options, right?
Yeah. Yep.
It's change really what you're looking for, or buy the rate down to get the payment where you want it.
Okay. Or one thing is you could put a bigger down payment.
Right.
Okay. So that's again the consultative part that we team up to guide our clients through that, to make these decisions, to say, here are your three options. Higher payment is going to cost you. What's more important? Is it worth it? And then they say, well, I don't know if it's worth it. And then that's when you'll do the exercise of how long you're going to be in the house. right? Is it worth paying $2,000, writing a check for $2,000 to basically get nothing, but you're saving $50 a month in 4 years? You're now you've made up that $2,000, and now you're saving the $50 a month.
Right.
So that's just one. So those are ways to get the payment down, right? Is to buy down the interest rate or improve your credit. Wait 6 months. Sometimes it's fix your credit. Pay this bill. Take that $2,000 to buy the rate down. Sometimes you'll tell them pay this medical bill from 2 years ago, as an example, so they can improve their credit.
Absolutely.
So that's another way to sort of massage the numbers.
Right. Exactly. I mean, it really comes down. It's so more in depth than, hey, Jason, what's the rate today? Right? Because
we've just spent that's 20 plus minutes talking about it.
That's what it is, right, out there in the market, right? Because people are selling loans and they're not getting to know the customer and they're not presenting options. Whereas it's more like a custom tailored situation where we have to get to know you really well in order to kind of advise you. And one of the things I think I do best is I always 100% of the time put myself in the client's shoes and look at all available options and come up with some suggestions, but with explanation, right? Here's a couple different avenues that we have available. Let's talk about it and see what's the perfect match for you.
Right. Okay. Yep. Yeah. And, the better your credit is, the better your income, the more cash you have on hand, the more options you have.
Right. Exactly.
There are a lot of home buyers, and this is, I want to switch a little bit into the challenge of today's market is that, the government realizes that not everybody has great credit and great income. And, sort of the cliche of, the American dream of home ownership, the government really, to a certain extent believes that. And so there's a lot of government subsidized loan programs to help people in those situations as well.
Well, yeah, I wouldn't necessarily call it like a subsidizing the payment, but let me explain it to you. I know that we touched base earlier on a guy with a 680 credit score, right? And how his adjustments to his rate will be higher than someone with an 800, right? But if he's a first-time home buyer, they're going to limit or completely eliminate what they call the service level price adjustments on the back end for like a first-time home buyer. So that person may, right, because they're not going to add those onto a first-time home buyer, maybe he'll get the same rate as a guy with an 800 or pretty close to the same deal because they're not going to penalize the first-time home buyer because they want to encourage home ownership. Yeah, exactly. Right? They want to encourage people to own their own home.
Yeah, that's a great point. So there's these government programs that, maybe
and that's conventional too. They'll limit service level price adjustments on conventional too, or limit them. Right.
Okay. So, and is that the banks just being nice, or is that the government saying we want the ability for people that maybe aren't flush with cash or have?
Well, it's not the government, right? Yeah. So Fannie Mae and Freddie Mac are going to dictate what the pricing adjustments are.
Okay.
Right, and they are going to completely eliminate or reduce them on first-time home buyers. That's one of the benefits of first-time home buyers.
Okay.
Right, and there's also other programs that are out there. FHA, right, is a great option for first-time home buyer with on basic situations. Again, something we review, right? Very custom tailored and presentation of various options and what's available. Yeah,
and that's that really. I'm glad you mentioned the FHA because. Here on the Meali team, one of the big things is that, everybody, we're agnostic about your financial situation. We want everyone we meet who wants to buy a house to find a way to get them within their means to obtain a house. And so, there's a lot of people that maybe are, I guess, not high income people, but they have the opportunity to buy a house as well because of these, again, not government programs or just...
Yeah, it's just the way things are. It's really the way things are set up. First-time home buyers, everyone's saying, oh, well, I'm a first-time home buyer. What are the benefits that are included in my status as that, right? And it's not someone who's never owned a house before. It's someone who hasn't owned a primary residence or property in the last 3 years, right? Could be considered that.
Okay. Yeah, so there's an incentive to get first-time home buyers the opportunity to buy a home,
right?
And we'll talk to anybody who has the if you have the desire to own a home, we'll give you a path to get there. And, how many people have we talked to that when they first meet us, they don't have the credit, some combination of cash or credit or income to buy a home. And 6 months later, they call us up and they said, I did what you told us to do, right?
Right.
And
or we follow up.
Yeah, and
right?
we follow up too, exactly. So we're going to work with you as long as it takes, as long as you're willing to, make the steps that you can to improve your profile. I guess.
Right, and it's really something that's different than the service level that you would get through an online lender or a big bank, right? If you come in and your credit score is not allowing you to do anything right now, it's the follow-up and the advice, whereas online banks are going to, sorry, you're denied.
Yeah.
And we're going to take some time, and we're still going to go through the process, right? We're going to get to know you. We're going to get to feel like where you're comfortable, you feel like payment-wise, and we're going to give you a path, right? A path to get where you want to be.
Yeah. Okay. And that's a great point, is that, we would love nothing more than to help everyone that walks in our door or that gives us a call on the phone to help them buy a house. And not everybody's in a position from day one, but we're going to help them get there.
Right.
And that's the difference between just calling the local bank and saying, hey, what's the rate today?
Right. It's a relationship business, and it's, helping people obtain what they want through our profession.
Right. Exactly. Okay. All right. So enough tooting our own horns here about how great we are. Let's wrap it up. And, thanks for your time today. This has been fun. Again, this is Bennett, Forrest from the Meali team at Keller Williams Legacy Partners, Jason Kilduff of Ward Kilduff Mortgage. Real quickly before we finish up here, how can people get in touch with you if they're interested?
I mean, here's my personal cell phone.
Okay.
Right. And
we'll put it on the screen, but go ahead.
860-716-3090. I pick that line up all the time.
Yeah.
Day or night. So feel free to reach out. You can text me at that number, or you can email me at jason@wardkilduff.com.
Okay, perfect. Okay, so this is something we get at the annual Keller Williams convention every year, a historical perspective on interest rates. And I love to show this to people because, we were talking offline earlier about how, again, if you are shopping the rate, or if you're saying, the rates, have they gone up? Have they gone down? People want to know, is this a good time to buy? And so if you look, and I had the luxury of, my entire career of being in this business was from 2009, where you see the interest rates were historically low, and even going back to 2012. So that's a whole decade of interest rates trending around 3.8. And I'll be the first one to admit, I knew it was going to end someday, but I got so used to it. It was literally my whole career, right? So in 2022, interest rates finally, after more than a decade, went up. And then this was, of course, we're taping this in October of 2023. So as we get towards the end of 2023, what's the interest rate today?
I mean, I would ballpark it, right? Mm-hmm. Just because we're recording, but ballpark it at 7.5 with an APR of 7.7 or something. But it's gonna change every day.
Every day,
right?
Okay.
And someone out there may be saying, "Oh, well, the rate's 6.75 today, but the APR is 7.7, right? Because they're gonna charge points in there."
Gotcha. Okay, so that's again what we talked about is knowing the difference between the rate and the APR. If the APR is a lot higher
than the rate, you can assume there's additional cost in there.
That the rate is lower because they're charging you elsewhere.
Right.
Okay. All right. So, it was historically low for 3.8. But what I like to point out is that, all right, now we're at 7.5. Well, look at this trend line going all the way back to 1972. We're basically I don't know if this is the median or the mean. It's a historical average from 1990. Where's this big long line? Here we go. From 72 to 20. So that's 40. Is that 50 years? That's almost 50 years, right?
51.
50.
Well, to 23. So.
Yeah, now we're at 40. Yeah. Now we're at 51, right? But this trend line goes all the way from 72 to 20, so 48 years, right? And so just like people say, well, the stock market goes up and down over time, up and down, but over time it almost always goes up. And so now that we've seen this cycle, so yes, it's back down to the trend line from going all the way from 1972 to 1920 or 2020, but that's again the historical average. And so you said you got in the business in what, 2001?
Yeah.
Okay. So in 2001, it was this. Did people buy houses in 2001?
Yes.
Okay. Did we sell a lot of houses in 2001?
Yes.
Okay. All right. And that's a different slide about the homes.
I bought a house in 2001.
Okay. There you go. And what was your interest rate?
I think it was six and a quarter.
Yeah.
Somewhere around there.
And at the time, did you think you were getting ripped off? Did you think, and you were were you in the business, or was that?
I was
okay.
in the business.
You're in the business. So at that time, did you remember what you guys felt about the 6-something% interest rate?
I didn't question it. It was about what was on the market, and I did, that's when, before I opened my company in 2006. So I worked for a large commercial lender, and I did the loan and moved forward. And I knew that there was going to be variations, and I knew I wasn't going to be in the house long enough, right? I knew it was a 3 or 5 year purchase for us, so I knew it didn't make sense to buy points at that time. Yeah. Right. And I thought it was a fair rate.
Exactly. You didn't say, in 9 years it's going to be 4. Would you have, if you knew then what you knew now, would you have waited 9 years to buy a house?
I wouldn't have.
Of course not, right?
Because the housing market's going up over time as well, right? So like I have that conversation with customers every day. They say, hey, I'm going to hit the sidelines for a while, wait for rates to get settled. If rates were to magically drop from, say, 7.5 to 5 tonight, the house that you're looking at is going to be more expensive, right? The value is going to go up.
So that's going to sort of counterbalance it.
Right. Like, would you rather pay $100 more a month right now, or $200 more a month right now, or $50,000 more for the house in 24 months when rates come back down?
Yeah. And what were you doing in 2001? Were you married?
Yeah.
Okay, so you're a newly married man. And if you think back, if you look at a picture of you and your wife in 2001, can you imagine if that was in an apartment, like if you weren't in that house and you were in an apartment because you didn't buy because you were worried about the interest rates?
Right.
Can you even imagine what your life would be like?
Homeownership is expensive, right?
Exactly.
Like no matter when you do it, it's going to be, they call it it's the biggest investment of your life. Right. And the reason is because it costs a lot of money.
Exactly.
Right?
Yep. So. And there's other things to look at. And, I'll use myself as an example. My wife and I bought a house in 2004. It was the same thing. We were newlyweds. We wanted to buy a house together. We didn't, we were, I think my friend from work said he got like a 6.3 and I was like 5.9, and I was like showing off to him that I was under 6.
Right.
Not even knowing again that in the future 6 would be considered high. And then again today 6 would be considered low. So it always changed. And then of course I always like to look back in 1980, 1980, it was 16.63. I mean, it was in the double digits really through the early 90s. And people still bought houses. People lived in houses. People bought houses.
Right.
I grew up in a house that was bought in 1975. So my parents, bought a house at 8%.
And if that's 18 or 16 on the screen, that's a high rate, right? But listen to this. If you're renting, you're paying 100% interest.
Okay. Tell me, why is that?
Right. You have no equity position, right? So you're just basically, there's no benefit to you to pay that outside of a place to live.
Okay.
So it's 100% interest, right? Just call it 100. You're spending all of that.
Okay. So if you're going back to the example earlier, so if you're paying rent $1,800 a month,
right,
all you're getting is the right to live there 30 days at a time.
Right.
Okay. If you have a house and now you're paying $2,000,
right,
but now you own the house, what are you getting besides getting the right to live there?
Well, you're reducing your loan balance. You're shifting it, right? So you're reducing the amount you owe, and you're accumulating the equity in your current house, right? So your principal portion of your mortgage payment's $500 a month and you're paying $2,000, right? Your loan balance is decreasing by $500 a month. So you're shifting that money from your bank account, you pay your mortgage, to the equity in your house because your mortgage balance is going down.
Okay, so you're paying off, by paying off your note, your equity is almost like you own the house. Like when you buy a house and you get a 30-year interest rate, you own the house. You have the right to do whatever you want legally with that house. You can paint it any color you want. You can do all that. But but as long as you owe the bank, as long as you have a note to the bank.
Well, you don't own it free and clear.
You don't own free and clear. There you go. That's it.
You have debt associated with it.
You have debt associated. So every month that you pay your that big mortgage payment that has principal, interest, tax, insurance, some of that at least every month goes to pay down your mortgage, which means that you're 1 month closer and X amount of dollars to owning your house free and clear, meaning no debt on it.
Right.
Okay. All right. Then you also have, of course, the house appreciates.
Right.
So in 3 years, if the house goes up 4%, now you've gained value on the asset that you own. You owe a little bit less, and it's worth a little bit more, right? And if you're in that same now, if you were paying that same $1,800 for 3 years, you're not getting you don't have any equity to show for it. Renting,
right? Exactly. You have nothing.
Yeah. Now you have the flexibility now. So renting is not, buying is not for everyone. Renting is, you get flexibility. If you don't know where you're going to be in 3 years, you might not want to invest.
Maintenance.
You don't have to worry about maintenance.
There's nothing wrong with renting.
But as a financial investment, that's where you get nothing as far as a financial investment.
Right. Exactly.
Okay, from being a renter. Okay. All right. So basically what we're saying is that mortgage rates are higher than they were, but they're not as high recently. They're not as high as they were many years in the past. And if you have the desire to have ownership, basically between Jason and I, or if you know your own realtor, your own lender, that you have a personal relationship, again, we talked about it being a relationship business. We want to earn everyone's business, but this is we're trying to provide value and hope this is informative. So, talk to if you have a relationship already, talk to them and have these kind of conversations to see if home ownership's right for you. And you make the best decision you can at the time with the finances you have. And then life changes. You can always refinance. There's things that change from that point on.
Right. And as you see on a graph, rates aren't going to stay where they are forever. They're going to move. There's hopefully going to be an opportunity to refinance and decrease the amount of interest that you're paying, right? Because that's what we're obviously always aiming for, right? Is either save money monthly or pay the house off sooner.
Okay.
Right?
Thanks for listening again. Jason Kilduff, Ward Kilduff Mortgage. If they want to get in touch with you, how do they do that?
You can call me on 860-716-3090. You can text me at that number as well. Or you can send me an email at jason@wardkilduff.com.
There we go. Now you can see us, and we're going to wave goodbye. Thanks for listening, everyone.
Take care.